This is Kurt Heisinger, accounting professor at Sierra College and author of Managerial Accounting. This video describes how to use differential analysis to make customer decisions. What I mean by that is we need often to decide as a company whether to keep or to drop a customer. Some customers are profitable, others are not profitable. It doesn't mean we always drop the ones that are not profitable, but we need to assess whether it makes sense to keep all of our customers. If you've looked at my video related to differential analysis and product line decisions, you're going to see many similarities here to what you saw in that video. In that, revenues, variable costs, and fixed costs are tracked by customer instead of by product line. Same idea though, it's just that we're going to track all of those different items by customer rather than by product line. And also fixed costs that cannot be traced directly to customers are allocated to customers. An example might be that we have salaries that go to our accounting department within our company, and we can't trace those costs directly to our customers. Our accounting department does a variety of things for the company, for our company, and not necessarily specifically for our customers. So if they're salaried folks within our company, then those fixed costs would be allocated to customers, and we'll talk about that more in just a minute. We're going to look at an example assuming that we are a landscape maintenance company. So we go out to different commercial properties and we make sure that the landscaping outside of the buildings is all maintained properly. That's our job. That's what our company does. And we have several different customers, and we're looking at one in particular, the Brumfield account, and trying to figure out, well, do we keep it or do we drop that account? And we'll see why we're assessing this on the next slide. So the three slides that you're going to see that follow this one will be, the first is for alternative 1, keeping all customers. The second slide will be for alternative 2, do we drop the Brumfield account? So the first is keeping all customers. Second one will show us the numbers related to what will happen if we drop the Brumfield account. And then the third slide will show then comparing the two, alternatives 1 and 2, and we can make a decision based on that financial information. This slide shows us what will happen if we keep all of our customers. And so what we're really focusing on here is the total column. This is just simply a total of these customers right here, the 3 customers that we have. Let's assume that these are all of our customers. They're big customers. Let's say they're commercial properties that we're maintaining for them. And you'll notice here that the first customer shows a loss of $15,000. The other customers appear to be profitable. So what we're assessing in the next couple of slides is whether we drop this customer given that we have a loss. Also, I want to point out, and I did this before with the product line video, that our allocated, the direct fixed costs, first of all, are easily traced to each individual customer and linked to each individual customer, the assumption being that if we decide to drop that customer, that direct fixed cost will go away. The allocated fixed costs are just that. We're taking the total fixed cost of $100,000 and we're allocating it to each of our customers. And in this example, we're allocating it based on their sales revenue in proportion to the total sales revenue. It can be done in many different ways. This is just one way to allocate fixed costs. So if you look at the Orth customer, for example, revenues total $300,000 for that customer, and our total revenue is $1 million. So $300,000 divided by $1 million is 30%. And if you take 30% times that 100,000, we get $30,000 allocated to that customer. So that's how the allocation takes place, and that will continue on the next slide when we assess what will happen when we drop the Brumfield account. This slide shows us what will happen, alternative 2, if we drop the Brumfield account. So you'll notice that this column is blank because we're assessing what will happen if we drop that customer. We still have the Hodges customer and the Orth customer, so you'll see those columns here. And you'll notice that what happens if we drop the Brumfield account is that our profit goes to $50,000. Remember, it was $55,000 in the previous slide in total, and we showed a loss over here for the Brumfield account, so we wanted to assess what will happen if we drop that account. Well, it turns out if we drop that account, our profits go down by $5,000. And the main reason for that is the allocated fixed costs, this $100,000, none of that goes away. It just gets reallocated to these 2 customers instead. So let's go to the next slide, and that'll compare the 2 alternatives. This slide shows us then what will happen. This is our differential analysis. What will happen with going from alternative 1 to alternative 2. Alternative 1 is to keep all customers. Alternative 2 is to drop one of our customers. And you'll see that if we keep all customers, we make $55,000 in profit. And if we drop the Brumfield account, we actually will make $50,000. Therefore, alternative 1 is higher in profit by $5,000. And the decision, that's what we're trying to get at here, what decision should we make? The decision then is to keep all of our customers because it will yield a higher profit by $5,000. These two charts summarize what we talked about on the previous slide. You'll see that in the first chart, this is if we keep all of our customers, that this first chart shows each individual customer, what will happen, and what will happen for the company in total in terms of profit. And our total profit is really what we're focusing on here, will be $55,000 if we keep all of our customers. You'll notice that if we drop one of the customers, if we drop the Brumfield account, you'll see the profits for each customer. But the profits for each customer, the Hodges and the Orth customers, actually goes down because more fixed costs are allocated to those customers and none are allocated, those allocated fixed costs that is, to the Brumfield account. And as a result, our profits go down to $50,000. So the choice then is to keep all customers.